for doing this kind of work. Okay, let's see if we can roll on this one without interruption. As they say. Okay, the sound is good. I guess we were on a bad line. So as I was saying yesterday, I was home with the kids, and my wife had gone down to DC to visit with one of our Italian cousins to show her the capital of the country. So I was at home and doing some work around the house, and we have one of those wireless systems there, and I could not get the thing to work. The software would just not connect with the router software. So all yesterday I was listening to something else, couldn't get it to work. Today I wake up and it's working fine. No rhyme or reason to it that I understand, but there we go. So we have the same thing here. Okay, so back to our current topic, the Chinese yuan, and what the Chinese yuan is telling us about the future. You know, as I said, you look around and you look for indicators, something to latch onto, so you can make an analysis about the world economy, about the United States economy, about the British economy, so you can get some sense of a long-term direction in things. And you have to find something to latch onto. So what are the number of things that I take? I'm distrustful of the usages of most economic statistics. It's not that I don't think they're valuable, I do, but they don't give you any long-term sense of what's driving things, because the world economy at the moment is no longer really, at least the markets, are no longer being driven by price discovery, a need for investment, of the typical things, the traditional things, the standard things that markets are designed to provide answers to. So you have to start operating with assumptions. One assumption that we can certainly operate is this one. I'll come back to the Chinese yuan in a second. Okay, now this is a chart of the, this goes back to 1980, of the US and German 10-year rates. I just put this chart up before I came in. So this is one assumption that we can operate on. We're looking for what's going to happen with the world economy, and everything's everywhere. So let's start with one assumption. And the assumption is that central banks are so far down the rabbit hole of low interest rates that it will take a very serious crisis for them to back off. We are not getting the results from low interest rates that one would expect, that nice equations for economists predict. So we can be sure that the current regime of ever lower interest rates, supposedly supporting economic growth, will continue. So that's one indicator. And what does that mean as an indicator? It certainly doesn't mean that the world economy, the US economy, the Japanese economy, the Chinese economy, the European economy is doing well. It doesn't mean either that the central banks can stop doing this. What will prevent the EU from continuing to try and lower rates to supposedly produce economic growth? It doesn't look like it's going to be because growth is going to come about. I mean, the Fed tried that. What happened? They got terrified. They got absolutely terrified. And the Fed has been the most adamant about the need to come back to a more normal rate structure. And they did one rate increase last December. The markets, in a technical term, totally freaked out, and they stopped. And since then, we've been listening to this endless talk from various Fed officials, how we're all set to do it again, hot, 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 be careful, here we come, watch out. I mean, have they never heard of the child's fable, The Boy Who Cried Wolf? It seems to be what they're doing with their communication policy. Now we're certainly not going to get a rate increase this month. We didn't get one in June. Are we going to get one in December? Frankly, who knows? I don't have any grasp really on the essence of Fed policy in the United States. In fact, I don't know what the essence of Fed policy is. So we can be sure that the current policies coming out of the world's central banks is going to continue, because they don't have any choice. If the goal is produce economic growth, it ain't working. But if they started raising rates, then what would happen? Well, the world would end in a recession. That's my guess, and I think that's what they're afraid of. So one indicator, looking forward, what is the rate environment going to be? It's going to be what it is or worse. What would get the ECB to stop raising rates, to stop trying to lower rates? Well, they run out of bonds to buy. They're already getting to that point. So there's this perverse effect, and this is happening in Japan too, that lowering rates, negative rates, doesn't seem to work. None of this stuff works as far as promoting economic growth. So what's the perverse effect? It's happening in Japan, it's happening in the EU. They're running out of bonds to buy to get rates even lower. The German 10-year is what we're looking at in the white there. Remember, there are two factors involved in markets and in economics. The substantive factor sits on economists' equations. And to that type of view, lower interest rates, even negative rates, are a plus, because it balances, it fits in their equations. I'm not an economist, so I'm not criticizing economists, but it's a way of looking at the world that has limitations which are not really recognized by the current leaders of the world's central banks, and you would have to say the world's politicians as well, the world's ruling politicians. So the other effect of this regimen of low interest rates and negative interest rates is psychological. If you want economic growth, what does that mean? Does it mean that the economy is a machine where you put an input in and you get an output? Is that the way the world economy works? Is that the way any economy works? Partially. But in between, where that equal sign in the equation sits, is an individual making a decision. Not a government official, not a central bank, but an individual in charge of a business. Jobs are not produced by government. Yes, government can hire people, but the economy runs on the private side. At that equation, at that equal sign, at that juncture between the input and the output, between the interest rate and the effect on the economy, sits an individual making a decision about whether to open a business, whether to expand their own business, whether to hire more people, and what do many business people use? Are they tenured academic economists, so they plug in their equations and say, hey, central bank has got lower rates, they're paying us to borrow money. Let's go out and do something. Or, and I know quite a few business people, both on the corporate side and on the small business side and the medium business side, relatives, friends. It's a widespread acquaintance of mine. I've been interested in this for a long time. No means statistical, but the decisions are based on two things. Well, more than two things, but two that I'm going to mention right now. One is the sense of the actual business that their company is engaged in and what the demand is and where they think it's going to grow. And the second is far harder, especially on the small business, the private business side rather than the corporate side. And that is some sort of intuition about what's going on. And this is where negative rates and low rates provide a negative input that does not fit into the economist's equations. It is impossible to believe, if you're a businessman or a commentator like myself, looking at interest rates around the world and where they keep headed, that this is a sign of success and a vote for future growth. It is only a sign of concern and weakness. And if that is your economic background, then the idea of you're going to err on the conservative side when it comes to what you're going to do. So I've had a long had the view that the interest rate policies being followed by the central banks have their own negative factors which are inhibiting the results that they want. So, back to the very beginning. What are we looking at around the world for indicators of where the world economy is going to go? One of the things we must look at is this chart. Is the descent of interest rates. We know the central banks are not going to pull back on this policy until they're forced to. Well, what might force them? Perversely, what's happening in Europe and in Japan, which I thought I didn't finish earlier, is that they're running out of bonds to buy. So what's going to happen? Is the Bank of Japan suddenly going to change their mind and stop buying and let rates go up? No, of course not. What they're going to do is take an ever greater share of the debt that is issued by governments. So this is where things get loony, although not publicly yet. You have Japan issuing debt, and you have the Bank of Japan, which is an arm of government buying the debt. As long as people believe fractional banking is a confidence-based system, as long as people believe that this works, it will work. It's when they stop believing that the things fall apart. Now, there is an added benefit to governments, or an added inhibition against people losing their faith in the system when it comes to something like the Bank of Japan buying its own debt, buying the debt of its own government and issuing money which has no real basis in anything. And that is, there really isn't any alternative system. So I think psychologically we would all be wary. It's not a leap that anyone wants to make. Because if they do, it's almost like the abyss yawns beyond it. So we can be sure that central banks will continue to do this because they have no other policy on hand. And God knows the politicians are not helping them. Two, that it will not stop until it's forced to stop. The old line, something that can't go on forever won't. Does that apply to this situation? I don't really have an answer to that one. what I just said is that there doesn't seem to be any alternative. The central banks have no other ideas. They are terrified of changing tact. So we have to assume that this policy will continue. Now let's move to the next one. And this policy, as I said, is not a vote of confidence in the world economy. Now this is the chart I had up earlier. The Chinese yuan. This is my other indicator that I'm looking at. Now, remember where we are. Let me just put up another chart. 1 second, here we go. This is historical from 1980 of the S&P 500. I think the most representative of the American equity indices. So, does this look like we got any problems? Nope, it does not. All-time high or very close to it. I forget what it was when it came in. I think it just made an all-time high today, but I'm not 100% sure. So as I sit here and talk about some of the problems I think that we're seeing in the world economy and where this is going, and how this just can't possibly bode well, equity cheerleaders are looking at these charts and saying, "What are you talking about? We're at an all-time high. How could this be bad?" Well, this period from right here is the absolute equivalent of not so much low rates, although that's true as well, but of a lack of alternative investment. And because remember, at this time, the world economy is not growing very well. The United States economy has averaged 2% and maybe 2.1% since the end of the recession. This is a hop, skip, and a jump, or maybe just a hop and a skip from recession. It's not far. Yet we have equity indexes at all-time high. It's impossible as a trader not to play what the markets are doing. But it is also true that because of this, now, the wealth effect was supposedly the reason for all of this stuff from the world central banks. If we need any more proof that the wealth effect is marginal at best, I don't know what it would be. Clearly, the wealth effect does not provide economic growth in any sustainable or serious fashion. Okay, so we have interest rates and central bank rate policies, which it does not seem, I mean, if the Fed wanted to normalize rates, well, I mean, even not knowing what normal rates are on the 10-year, is it 3%? Even if it's 2%. Here's the 10-year, okay? These are the rates over here. This is the 10-year rate, okay? Steadily coming down since the early 1980s. You have 10-year rates at 14%. It would hard over the future to get a normal economy, even a blow-up, not to have rates come down. So part of the trend, of course, is simply of a function of that peak under Volcker in the early 1980s. Nonetheless, what would be a normal set of rates? Well, looking at this chart, you'd say it might be 4%. Historically, that's of course assuming that the makeup of the economy doesn't change. Of course it does. So let's assume it's 2%. That would imply a 60 basis point rise from here to 2%. Let's say the Fed funds rate does that as well. So we would need, Fed funds rate's going to go to 1.5 or something like that. Okay, 1%. Can the Fed do it? And two, are they willing to do it with its results in the economy? And it seems to be that the answer is no. Okay, so we know that this central bank policy is going to continue. That's one sign. And here's my other sign that I look to for impact and for an actual depiction of something that's important rather than what people say about it and what some of the statistics are. And of course, this is the yuan. And why am I looking at this? Well, look at the chart. Since 2014, the beginning, the yuan has gained, this is against the dollar. The reason I'm not using the trade-weighted basket is because when it comes to the psychological factor of what I'm going to talk about, I think the dollar yuan is more telling than the basket that it's traded against or the actual trade-weighted yuan, according to the trade interactions out of the People's Republic of China. Here and here, August 2015, almost a year ago, and 7 months ago in January, the markets had, as I said, in a technical term, a total freak out about China. We're now considerably lower in the value of yuan than we were then. And the S&P is at its all-time high. What is going on here? Does this not mean that the Chinese economy, export dependent, overdeveloped, is attempting to export deflation? That's not their goal. That's the result. Their goal is to keep people working. There's a whole series of industries, steel being the best example, that with their fiscal policies, spending money, have overdeveloped as far as capacity goes. Well, what do you do with the steel plant? I think that in the past 3 or 4 years, or maybe it's 5 years, that the Chinese have built as much steel capacity as the rest of the world put together. Who's going to buy all this stuff? Well, if you can't sell something and it's a subsidized product, what do? You lower the prices. And so by devaluing the yuan, which is what they are doing, it's at a considerably lower rate against the dollar than it was in January when the worlds were, remember what let's take a look. Bring up the S&P back in January. Here we go. Over here, S&P. That's, oops, sorry, I've got to put it up. Okay, here we go. Okay, there we go, sorry. S&P right here. It's not a great chart for it, I know, it's a long-term chart. That's the freak out, technical term, in January, largely associated with this. The devaluation of the yuan. Well, we're much lower now than we were then. We are headed here. I mean, I don't think the markets are going to start paying attention to this until this gets back to here. This is about 6.83, this period through here, where the Chinese government held the yuan through the financial crash and the aftermath. So why do I focus on this? Because it is one of those statistics that tells a story much greater than the other statistics measuring the strength of the economy, because this one is, one, determined by the government, by its policy, and two, really does determine a good portion of the interaction with the world. The Chinese can say their economy is growing 6.8%, whatever it is. Doesn't mean it's true. But if they were happy with the progress, and the state of the economy, why would they be devaluing the yuan at such a rapid, look at this rise right here. This rise looks just like this rise, and it looks just like this rise, although a little bit less. This tells me that things are not well on the mainland. And what effects do you have of a devaluing yuan? Well, you get China's an export nation, so is Korea, so is Japan, so is Indonesia, so is Vietnam. A devaluing yuan means all those other currencies are going to devalue as well. It means that deflation or disinflation is going to be with us as a pressure in the world economy and world prices for some time, which also means that the central banks are not going. The only thing they know how to do with deflation is to print more money, which is what they're doing. So this is telling us that both substantively, the Chinese economy is not doing well. Otherwise, they wouldn't be doing this. And it's deliberate. Remember, this is a choice. This is something that reflects the reality of the mainland economy, not the semi-fanciful statistics that are basically produced by the government to satisfy the government's own goals. So for many of that's the substantive side of it. This is telling us that things are not as copacetic in China as the statistics maintain. But the psychological factor, I think, is as important, although the market is currently not paying attention to it. Much of the marginal demand certainly in commodities, has been driven by anticipatory effects based on what the Chinese economy is going to do. Iron ore, many of the resource oil, many of the resource-based economies and commodities over which there was so much fuss about when they hit bottom a few months ago, and of course they've bounced somewhat since then, was because China was expected, or had been expected, to provide, if not endless, certainly surging demand. Absent that idea, there's very little reason to speculate in commodities. So the psychological idea, if you look at Europe, nobody is expecting growth out of Europe. Look at Japan. Who's expecting growth out of Japan? Well, not me anyway. The United States. We're talking about the biggest economic blocs in the world. Europe, probably not going to grow. Japan, which is actually number 4, I guess. If you actually put in terms of economic size, it goes the EU, United States, China, and Japan. So where can we look for growth? We're not going to get out of the EU. If you don't believe me, if you need a sign, look at sovereign rates in the European Union. 10 trillion around the world now. 8 trillion or so, maybe 7 trillion of those are in Japan. Still, no one can expect a great deal of growth out of sovereign rates there, because that's what the rates are telling you. It's not going to happen. So we're not going to get it out of Europe. The United States, growing more than anyone else. So could have the United States. China and Japan. Well, no one's expecting Japan. Japan's record over the past generation has been dismal. Abenomics in its first arrow has failed, or is very close to failure. The other two aren't even being talked about yet. And so the only place there was going to be the hope for demand for all sorts of things was out of mainland China. Infrastructure to develop 1.5 billion people, on and on and on. The entire idea, if I can sell one pencil to everyone in China, I'll be a billionaire. Okay, well, maybe that's true, maybe it's not. The Chinese are trying to sell pencils to their own people as well. But that idea is a powerful force for speculative movements in markets. And if that falters, think of it another way. Everyone has stopped paying attention to the Chinese yuan, even though its signals are worse considerably as predictors for what's going on in China and its effect on the world economy than they were 7 months ago or 11 months ago. Worse, much worse. Look at the chart. But nobody's paying any attention right now. So what would it take to get a market's attention? As we all know, markets are very flighty. They usually don't look at the same thing twice. Unusually, they did twice in China, but now they're completely ignoring it. So what would happen? Well, if the Chinese official GDP statistics came in at 3% rather than 6.8, you would have a massive impact on global market psychology. Is that going to happen? Nope, probably not. China's not going to do that. They're not going to come back with figures suddenly that have growth, because everything would hit the fan, so to speak. So why is the S&P and the other equity levels back where they are? Because the trading impetus is back. The Fed is not going to be raising rates. Everybody else is lowering rates. The standard response that we have had basically since the financial crisis is still with us. And it doesn't matter whether that is a logical, whether that is based in economics. After all, markets are about making trading profits. They're not necessarily about investing. So if the world central banks are going to continue their low rate policies, which when we looked at the interest rate chart for the US and the German 10-year and examined that idea, there isn't any out that I've been able to see. The ECB, not only are they worried about the European economy, they're now worried about what the Brits are going to do. Although I hear Theresa May is going to be the new prime minister, and it looks very much like the Tory party, which officially at least was behind the Remain vote under David Cameron, is putting in place people who are in the ministers who will actually be negotiating this, quote, departure from the EU, and they're all believers in staying in the EU. So it will be interesting to see how much actually gets accomplished. And my guess is not nearly as much as would have been the case if Boris Johnson and people of his, and Michael Gove, had been in charge of the British government. But they are not. Theresa May is going to be the new prime minister. So the both speed and degree of the British exit, quote, from the EU is now going to be moderated. I don't think there's any question about that. They have all said that they will respect the wishes of the British people. Let us wait and see how that actually plays out. But on the interest rate side, the ECB is foursquare behind continuing low rates and lower rates, regardless of whether they're working or not. They're not working. They have no place to go. That's what they do. So the interest rates will continue. If they're looking for another reason, the chart's right in front of us. It's the potential deflation out of the Chinese devaluation of the yuan, which is continuing. Can everyone still hear me? I'm trying to make sure the microphone didn't jump out of existence here. Okay. So both of these indicators for the immediate and near-term and medium-term future of the world economy are, to my mind, negative. If China is devaluing its currency, then there will be necessarily competitive devaluations in many currencies around the world. Most currencies are traded against the dollar. If you are devaluing your currency, then the dollar gets stronger. If the dollar gets stronger, we're back to its effect on the US manufacturing sector. Now, it has been proven that the indicator relationship of the US manufacturing sector to the overall economy seems to be not as accurate a predictor as it was. One reason, I mean, manufacturing is like between, I don't know, 10 and 15% of the US economy. Yet it's always been viewed as a leading indicator for the overall US economy. Manufacturing has essentially been in recession for 18 months in the US. But it has not led or indicated that the rest of the economy will follow, because it hasn't. But we are going back to that stage where the US economy, the last one growing at any reasonable rate. I mean, China, yes, but remember, China's real rate, one, is considerably lower than the one that they say it is, and two, the world economy has gotten used to demand from China based on these historically astronomically high growth rates, 7, 8, 9, 10%. So the relative movement of the Chinese economy is what's important. The US imports far more consumer goods than China does. So it supports consumer good manufacturing around the world, much of it from China. But consumption in the US is based on wages, which are still not rising. And one of the reasons they're not rising is the chart you're looking at here. Deflation, disinflation, price pressures. No one has to raise wages. So if China is slowing, which is what this chart is telling us, regardless of the feel-good statistics coming out of the Chinese government. Remember, there are almost no alternative market does a series. The British economics firm does a series of ISM reports from China that have been uniformly lower, much more pessimistic than the reports coming out of the Chinese government. Nonetheless, the impact of this chart and what it's telling us is one which does not bode well for the world economy. So, of the three indicators that you can look at, three market-based indicators that you can look at for, but remember, stock market is supposed to be discounters of the future. They're supposed to be basing prices on future income streams. That's what they're supposed to do. Clearly, it's not what they're doing, but that's what they're supposed to be doing. So the three markets you're going to look at, equities, bonds, and currencies, four indicators of where the world economy is headed. Two of the three are showing, in my mind, very extreme levels of concern about where this is going. Bonds, credit. We've talked about that extensively today. What negative rates mean and what they predict. Neither one is good. When we look at currency markets, which is why I have this chart up here, the predictor factor, regardless of, just ignore the United States for the moment, is that the world's second largest economy, or third, depending on how you look at it, is in dire need of assistance. Remember, the Chinese said, I think, I'm not sure exactly when, but the government definitely said, we're going to keep the yuan stable. Well, to quote one of our favorite presidents, I suppose that means what the definition of stable is. This is not stable. So the currency markets, at least here, and the bond market, the international, global, domestic, whatever you want to look at, are telling us the same thing. The only market type that is, from its level, looking optimistic are the equities. And one must examine the reason why equities, at least in the United States, are popping such ridiculously high levels, with the economy growing basically 2% this year. So when we look around and we're looking for directions in the global economy, it's tough to find a reason to expect a return to normal growth levels. Now, because of the situation when it comes to negative interest rates and the incredibly low regimen of interest rates right now, partially or mostly due to central bank policies, which the world has never encountered before. So remember, it's not just this imaginary entity, the world economy, but it is the people in charge around the world of central bank policy have run out of options. Have we seen any of the ostensible goals of central bank rate policy move any closer to achievement because of what they're doing? And the answer has to be no. So if we know empirically that the policies are not successful, and we also know logically that they're not going to change, then when we look at the future and say, where are we going to go with this? If the US 10-year, now we had a bit of a bump today. In the 10-year, and the US 10-year went up a bit, and return went up a bit. But if, by and large, let's take a look at the, let's take a look at the rate again. Here we go, S&P 10, German US 10-year. It's back here and here. Anticipation of rate policies, didn't happen. Okay, cool. Where do we go with this? What is this telling us? And it's telling us exactly the same thing that the Chinese yuan is telling us. That the potential for growth is not there. Not under the current policy, not under the current situation, not under the current economic regimen around the world. So when we look for a survey, when we look at a survey of the global economy, I, for one, have a hard time finding logical reasons to be optimistic. It does seem that negative policies are able, or very low interest rate policies are able to stave off collapse, to prevent recessions, at least they have so far, although certainly not in Japan. Japan keeps dipping in and out of recession for almost 15 years now. I think they've had 3 since by, two quarters of negative growth since 2008. Is Japan a predictor? Is it true that minimal interest rate policies have the opposite effect of what they're intended, that we actually do live in that analogy I used in a few webinars ago of quantum rates, quantum physics, where as you get closer to, as you get smaller and smaller in size, the normal rules don't apply as far as physical properties go. Is that true in economics? Where as you get lower and lower and lower, the normal equative results of one side of the equation to the other no longer apply? That seems to be the case. I don't know of any proof of this. I don't know of any economists who tried to put this into a theory, but it certainly seems to be the case. So looking at the survey of the global economy, just to restate, of the 3 markets that we looked at today, equities, bonds, and currencies, 2 of the 3 are predicting low growth or no growth and problems ahead for the world economy. The one that is not, equities, can be taken as the same type. You can actually make the case that the levels in the equities are based entirely on central bank promotion. And when that stops, the markets stop. Okay, folks, thank you all very much for attending. I hope this was useful. I'm sorry I'm not here to be more optimistic. I attempt to analyze without emotion. I doubt I'm 100%. I'm sure I'm not as successful as I'd like to be, but that's always our goal here. I am not attempting to promote a view of the end of the world economy or anything like that, but I do think that the analysis as predicted by markets is such that there is great cause for concern out there. Okay, thank you all very much for attending. I take it, as I said, a great compliment that people take time out from their day to listen. I thank FX Street for the facilities to put this on, and I hope you all have a great day. I will type in my email address So if anyone has any questions or comments, you can certainly email me and I'll respond as quickly as possible. Again, thank you all very much for attending, and everyone have a good day.